On the morning action, we have Ken Polcari of ICAP Corporates right here on the floor of the New York Stock Exchange. The one and only Kenny Polcari. Also, we got Team Chicago by Iacchino of Trader Outlook.com on the bond market. And, of course, Lincoln Ellis, a frequent guest on Bloomberg Television, watching the currencies. All right, guys, we'll bring you in just a moment, but let's get the take right here on the floor of New York Stock Exchange. As I walk around, I get the sense that everyone is saying, sell any rally you see.
And that's exactly right. And it's really more of the same, right? We've seen continuing weakening U.S. macro data. Every day we look at it. Every day we hope that it's going to stabilize and get better. And in fact, all we do is see it get weaker. So every opportunity the market rallies, people are selling right into it. We're going to hit our head. You know, we're down here now at 1,300 again, almost. My sense is, once again, we're going to test the 1279-ish level, the 200-day. And any rally above 1310, 1315, they're going to sell right into it.
And by the way, you know, think about the difference. And Lincoln Ellis, let me bring you in here on this one, because think of the difference, right? A couple of months ago, people were saying bad news is good news because it means we're going to get some sort of QE3. We don't seem to be getting it. You've been calling for this for a long time, that we'd be going back down. How are you playing things today, Lincoln?
Well, it's interesting. The currency markets are definitely reflecting what Kenny's seeing out there, and that is a massive move to risk aversion. You've seen it in selling off in the sterling. You've seen it in the move, significant move in euro yen and dollar yen over the course of the last 2 days. And obviously, you know, moving into bond space a little bit, these yield low prints are absolutely telling you that things are not only soft, they're scary.
Yeah, they are a little bit scary. We try to avoid adjectives like that, but I understand where you're coming from. Hey, Bob, let me ask you on the bonds. You know, a lot of guys are saying, hey, 159 on the U.S. 10-year. That actually is a bargain when you consider the fact that Sweden's at 130, Germany's at 124, Switzerland is at 81 bips. What's your take on the bond trade right now?
Well, I don't know if I call it a bargain when you look at the debt to GDP ratio of the U.S. versus those countries. I just think the more you see these yields shrink, the more the lower and lower and lower they go, the worse that is for the equities, the stronger dollar that you see. And moving into Lincoln's territory a little bit, the dollar index strength is just mind-boggling to me. We're going back to levels we saw during the crisis. And I'm sorry, but let's stop all the talking about Europe. It's United States of Europe or it's a breakup of Europe, one of the two. These little baby steps they're taking are going to continue everything that the other two gentlemen were talking about. All the fear, all the equity weakness, all the dollar strength, and all the bond market low yields are going to continue until one of those two things happens.
Hey, Lincoln, you playing the dollar long against a short euro right now?
Definitely no longer long the dollar. I do think that, you know, we're sort of running its course here, both in terms of the relevance of buying dollars to buy those U.S. Treasury assets, and the spreads, while they've blown out a little bit between Treasuries and Bunds, are now at levels where, and you saw this in Schatz over the last couple of days, the 2-year notes in Germany, that they've been actually down. So you're taking on more risk at the shorter end of the yield curve, and obviously now the 10-year looks like the short end of the yield curve. And given the dollar's move, I'm not so sure it's got too much further to go.
All right, Lincoln Ellis, Bob Iacchino out in Chicago, Team Chicago. Thanks, guys, for joining us. Kenny Polcari, quickly before I let you go, your target right now for the next week or so on the S&P short term.
I think we're going to hit 1279, which is the 200-day, and I wouldn't be surprised if we see it there over the course of the next couple of days. We're coming into June. Operation Twist is coming to an end. We're not hearing from Ben Bernanke, although I think that's more of a ploy. I think we are going to hear from him because I think we are going to get a QE3 program.
Okay, so that's down about 2.5%, 3%. Kenny Polcari, I'll talk to you in about an hour. Yep.